Okay, so today we're going to be talking about 3 stocks that I think are potentially undervalued. Now the key word here is potentially because this is not a recommendation for you to buy, sell, short any stocks, by the way. I am not a financial advisor and this video is for education and entertainment purposes only. So what I'm trying to say is, please don't sue me. Okay, actually, before I begin, I just gotta say, every time I make these undervalued stocks videos, I always get a few people down in the comments being like,
"What the heck, man? These are the worst stocks you can possibly pick. Dislike, unsubbed."
Listen here, buddy. I know these stocks are being down, okay? So, that's why some people consider them to be undervalued. Have you considered that maybe there's a reason why these stocks are being down? I would love to buy Tesla and Amazon and Apple for like a 4P of 15, but we all know that that's not happening anytime soon. So if you're gonna buy into these stocks that are on this list, and I'm not saying you should, by the way, but if you are going to, then that's a risk that you're gonna have to take, and that's a risk that you're gonna have to keep in mind. So just hold your horses a bit and hear me out, okay? And also, we're not gonna get into super in-depth reviews of these stocks, by the way. We do have a lot to cover, so forgive me if I miss anything. But if you want me to do an in-depth analysis of any of these stocks, be sure to let me know down in the comments below. So anyways, without further ado, the first stock on this list is Foot Locker, ticker symbol FL. So you guys have probably heard of Foot Locker. They're a chain of stores here in Canada and the United States, and they sell shoes. So, the business model is not too difficult to understand. So they sell shoes from pretty well-known brands that you would recognize here, that I'll show a picture of, as well as brands that they own themselves. So with Foot Locker, it's definitely a business that's been being down pretty badly. So if you look at a 5-year chart right now, you can see that the recent pullback was caused by the Roni situation, as malls are being forced to close. And, Foot Locker stores are mainly based within these huge shopping malls. However, there are some pretty positive news that are coming out of the company that I think makes this stock potentially very attractive. So first of all, let's talk about the valuation. So this company is trading at a forward PE of currently of around 8 right now, which looks pretty cheap in my opinion. Also, during the latest earnings report, the company has bounced back to profitability in Q2 of 2020 after posting a loss in Q1 of 2020. And their adjusted EPS actually came in higher than expected with revenue in line. What's most notable, however, is that the same store sales actually rose 18.6% in the past quarter, showing a very strong recovery in progress. And the company also reinstated the dividend to 15 cents per share, which granted is still lower than the previous dividend, which was around 40 cents per share. But the fact that they're able to reinstate a dividend at all right now is still very impressive. So overall, what's the strong reason for this recovery, you might ask? Well, if you think about it for a moment, I think the answer to this question is actually very simple if you just stopped for a moment and thought about it. And the reason is that people still like to buy shoes in person, right? So I know we're all moving towards e-commerce these days, and some things like shoes, I think it might still be better for you to buy in person just because shoes need to fit exactly, right? So if you ordered a shirt online, for example, and it doesn't fit exactly perfectly, you might not want to go through the hassle of going to return it and stuff like that. But with shoes, it's pretty different, right? So if you buy a pair of shoes, you really want them to fit exactly right. So I think for most people, they still want to go into the store and try on the shoes before they commit to buying them. So I think that the business of Foot Locker is still very solid, even in today's technology-driven environment. And it's not like they don't have any online presence at all. They're also trying to move towards e-commerce side of things as well. So I think overall, you're getting a tremendous value for Foot Locker if you buy the stock at today's prices. So anyways, that's Foot Locker. Now moving on, for stock number 2, I picked Tapestry, ticker symbol TPR. Now, I gotta thank Jeremy from Financial Education for bringing this to my attention because he talked about it on his channel, and I gotta say, I agree with him on this one. So Tapestry, if you don't know, is the owner of many famous brands like Kate Spade, Stuart Weitzman, and most notably Coach. And yeah, they're mostly known for making purses and handbags for women, but obviously they have a bunch of other items as well that has to do with fashion. And yeah, fun fact, I actually own a Coach wallet, and I've been using this for years, and basically it's pretty high quality. There's been no problems with it. I've had no quality issues with it. I have wallets in the past that just break down after like a year or two, but I've used one for well over a year, I think 3 years at least. And yeah, it still looks like brand new and it hasn't broken or anything. It's held up really well. So yeah, anyways, let's go back to talk about the stock though. So again, what attracts me to this stock is the valuation. So if you look at the forward PE right now, it's sitting at less than 7. So the whole company is only worth about $4 billion in terms of market cap right now, which seems cheap if you think about how famous just the brands that they own are. Now, obviously, fashion is one of the worst industries to be in the midst of a global pandemic that's causing stores to shut down. And if you look at a stock chart, you can see that the stock has just fallen off a cliff since the Roni situation started. But I would argue that by this point, most of the negative news has already been priced into the stock. And if you look at the financials of the company, yes, they did lose money in the bottom line in the past 2 quarters, but I just want to point out that it's mostly because of the massive revenue decline that they've experienced because of the Roni situation, and their operating expenses have actually come down since last quarter. And if you look at net income, they did lose almost $300 million in the past quarter, which is not good. These aren't small potatoes, but let me just point out that the loss is actually significantly smaller than the loss they experienced just the quarter before. It's about less than half of the loss that they experienced the quarter before. So all in all, I think it is a good sign that the recovery effort is well on its way, and if they manage to pull themselves out of this crisis, I think the stock will go much higher than what it is now. So that's Tapestry. And moving on, the next up on the list is Bank of America, ticker symbol BAC. Now, this is actually not my pick, this is Warren Buffett's pick, because as we saw in a filing last month, Warren Buffett's company, Berkshire Hathaway, has bought over $2 billion worth of Bank of America stock since mid-July, and Berkshire now owns 11.5% of the entire bank, which in total is about a $27.4 billion position, which makes it Buffett's second biggest holding, besides, of course, Apple. And keep in mind that this news comes at a time when we see reports of Warren Buffett cutting his stake in other banks like Wells Fargo, which, if you know anything about Wells Fargo, you know that they're not doing so hot at the moment. And I thought about putting Wells Fargo on this list instead of Bank of America, but I think at this point it's safe to say that Wells Fargo is pretty much the worst bank out of all the major American banks. And in my opinion, you should always try to avoid buying the worst company in any given industry, even if their stock is cheap. So unless you have some other information that gives you confidence that they're not going to be the worst company 5 years from now. But looking at Wells Fargo right now, it's just a mess, right? So I don't really have that much confidence in them, quite frankly, at the moment, which is why I picked Bank of America instead, which has the vote of confidence of Warren Buffett. Anyways, back to Bank of America stock. Now, according to Yahoo Finance, the forward PE currently sits at about 12, which is actually not that cheap in my opinion, because banks traditionally always trade kind of cheap. However, looking at their earnings history, we can see that the last quarter they did beat EPS estimates by quite a healthy margin. And overall, the way I think about it is, I looked up the bank account interest of savings accounts that's being offered by Bank of America, and they might as well be zero, right? They're so low. They're like 0.05% for the top tier, which leads me to think why they even bother at this point, honestly. So if you look at the stock, the dividend yield of Bank of America right now is about 2.8%. So that's pretty much more reasonable compared to what you would typically expect out of a savings account in simpler times. Also, keep in mind, investing in a bank stock is kind of different than investing in other companies, because banks at this point, especially American banks, they're essentially backed by the government. So, say if you put your money into some other previous companies that we talked about in this video, say you put your money into Tapestry, right? And let's say that things go wrong and it doesn't work out, and let's say Tapestry goes under, right? So the government might not care about Tapestry if they go under. Versus with Bank of America, I can't see a scenario where if Bank of America were to go under or they have financial difficulty, the government would not care about them. So I think that if Bank of America were at risk of failing, the government would definitely bail them out. So this makes it a pretty safe investment. At least you won't lose a significant chunk of your money. I mean, the stock could go down, but you won't lose 100% of the money that you put in, let's just say that. And also you're getting a 2.8% yield, which granted is not guaranteed, but it's kind of like a savings account, right? So if you just look at how the math works, I can put my money into a savings account and get 0.05%, or I can just buy the stock and get 2.8%. And also, there's a chance that the shares might go up in price, so I actually might make more money from capital gains apart from the dividend. So I think that it is a value play, but at the same time, you can kind of think about Bank of America stock as just another savings account. You put money into the stock, and it's just like a savings account at this point, honestly. So yeah, that's nice, and that's Bank of America stock. Now I'm going to leave this video here because it's getting a little long, but be sure to hit the like button if you enjoyed the video, and consider subscribing if you like the series. Be sure to follow me on Twitter and Instagram, links down below in the description as always. And with that being said, I'll see you guys in the next video. Bye-bye!